Reserve Bank Governor Philip Lowe told workers that they are greedy if they're expecting their wages to go up with inflation, because if it did, it would sink our economy into an inflationary spiral that would be hard to get out of. We discuss that in today's Property Insider video, together with the latest changes to the New South Wales Stamp Duty regulations, and actually what's happening on the ground in our property markets as our auction clearance rates tell a tale. If you'd like to keep up to date with what's happening in our housing markets, please subscribe to this YouTube channel and click the little bell icon so we can keep you informed each time a new show comes out. Reserve Bank Governor Philip Lowe has been keen to tell us his views on what's ahead for inflation, what he's planning to do about it, and what's likely to happen to interest rates. Now, only last year he said the Reserve Bank wouldn't increase interest rates until they saw signs of strong, real wages growth. But then last week he told workers that they shouldn't be looking forward to wages growth to match inflation. In other words, if they don't accept cuts in real wages, then their greed, and now that's my word, but their greed will be responsible for a level of inflation that will be difficult to control without sinking the economy. But Philip Lowe also reassured us that the rapid rise in interest rates that he's planning will not tip the nation into recession. There's lots to unpack from this discussion, so I'm looking forward to my weekly Property Insider chat with Dr. Andrew Wilson, Chief Economist of My Housing Market. Hi, Andrew.
Yeah, good day, Michael.
Well, the Reserve Bank's busy telling us what's ahead. What are your thoughts about all that? I mean, inflation's only running at 5.1%, and now he's suggesting it's going to go to 7% by the end of the year. But he wants to see wages growth start with a 3 in front of it, and suggested that if there's a 4 or 5 in front of average wages growth, it would be really hard to return inflation to their band of 2.5 or 2 to 3%.
I'm not sure about the merit of all this forward guidance that we get from our central banks or from the RBA, Michael. I guess there's a responsibility to educate the community in terms of what the Reserve Bank feels that the outlook is. But in times of uncertainty, it can be self-defeating to a certain degree. One of the self-defeating aspects is the credibility of the bank itself. And certainly we've had a lot of changes to the forward guidance that's been provided really over a number of years now from the Reserve Bank. And perhaps they should just tone it down a little bit and just really focus more on what's happening now in terms of the data coming through, and leave a lot of that sort forward guidance behind closed doors and not have to take the hits from being wrong. And we've certainly seen a lot of not just marginally incorrect outlooks for the economy and monetary policy, but significant changes to monetary policy. And as I said, I'm not sure that's good for confidence going forward. And even with the, as you were alluding to, the current insights from the Reserve Bank Governor tend to be highly gilded with uncertainty, could be, should be, would be, maybe. There's nothing really solid in terms of the outlook. And I'm not criticising the Reserve Bank Governor for that. I'm just saying that it's is it wise to be saying, well, basically, I don't know what's happening and I don't know what's going to happen going forward. But I think that's really the essence of everything. And now every second word in conversations regarding inflation and interest rates is the word recession. And that can also become a negative in terms of investment decisions and purchasing decisions going forward. And it's one thing to expect inflationary expectations, but are we now creating an expectation of a significant economic downturn? And let's remember, in reality, we've only ever had one recession, and that, of course, was the early 90s. The recession we had through COVID was a Clayton's recession. It was just a response to lockdown, basically over one quarter. But we don't want to revisit the horrors of the early 90s, which came about through trying to control inflation with extraordinary high interest rates. Previously, the governor's been talking about, they're certain that wages are rising behind the scene, ignore the official data. Isn't that a positive? Well, no, because that's what fuels inflation. And the point to higher wages is that the impact of higher wages on inflation is not, as the bank was suggesting, mechanical, in the sense there's always a lag from the point, particularly in a strong economy with full employment, a lag from where businesses have to pay more for their workers and then when they finally have to start to pass it on with higher prices for their products, their goods and services. So that's in the gun now, particularly with the Wage Commission decisions, that those higher wages as they come through will work their way back into inflation. And I noticed that the markets, whatever the markets are, Michael, that mysterious purveyor of all knowledge to do with the economy, are now predicting 4% official rates by the end of the year. I think you've pointed that out. That means that we basically have to get a 0.5% increase in every month for the remainder of the year, plus a 0.75. So heady times ahead. The governor said, no, he didn't think that was going to happen, but let's hope it doesn't, because that really is a sledgehammer to the economy.
Well, Philip Lowe said there's no preset path for interest rates. So while the market believes interest rates are going to go a bit higher, Reserve Bank board said that they're watching the household spending carefully. They're watching what's happening carefully. And sure, there's some external factors driving inflation in Australia, globally, factors as well. And they're likely still to keep going through the system for, I guess, the rest of the year. So inflation is likely to rise quite strongly before the end of the year.
Yes, so perhaps a glimmer of hope, Michael, however, that we're starting to now see, and this is probably a false dawn, that the price of oil is starting to fall. So let's keep our fingers crossed that we can see a consistent downward trend in oil prices, and that would go a long way towards offsetting our inflationary issues. But we do, however, have this emerging problem with food shortages globally, and that's a lot more difficult to fix. And we're seeing the impact of reduced supply of grain out of the Ukraine and what impact that is having. And, Michael, there's a lot of leverage there if we start getting food shortages in terms of the geopolitical climate in Europe.
Oh, yes.
And if I could just sort of personalise it, Michael, I paid $7 for a lettuce last week.
You got a bargain, because I heard they're $11 or $12. So I looked them up to see why. And interestingly, it is fuel. It's transport that's about the third of the cost. People don't realise there's fuel in transporting everything. The other thing, interestingly, was fertiliser is a huge part of the extra cost of lettuce. And then there's also labour. So it's actually not the bloods that's caused it. It's all those other factors, isn't it?
Yes, it is. Isn't that a classic example, Michael, as you explained, about the tentacles that can drive a particular commodity that we talk about, a lettuce, but it's all those factors that have pushed prices up to what I would consider outrageous levels. And it was a pretty small lettuce, let me tell you. I'm cherishing each particular leaf, because it's not just the cost, it's also that there's only a handful of them down there, in the supermarkets. So, but this is inflation for you, and this is what we have.
Well, interestingly, we went to a restaurant on Saturday, and the waitress actually explained that the particular salad that was on the written menu wasn't available. I guess they couldn't get lettuce either.
No.
And over the last week, the New South Wales government brought in their new budget, and they gave some optional relief for first home buyers. They're going to be able to avoid stamp duty when they buy a property from January next year. That's a plan to replace stamp duty with land tax. It's been touted for a while, and it's received a lot of media attention.
Well, there was perhaps a possibility that the New South Wales government would bite the bullet and go the whole hog and do it for everybody, would get rid of stamp duty for all property purchases or residential property purchases and replace that with land tax. Perhaps that was a bridge too far. So we've now sort of transferred that to first home buyers. First home buyers, if they take the bait and decide not to offset or to have the choice between a land tax and paying stamp duty, are also going to be in strong competition with the new first home buyer deposit scheme, or the extended first home buyer deposit scheme, which comes into force at the end of this week. So it's good news for first home buyers generally, and also perhaps more good news in the shorter term for New South Wales first home buyers. But then they've got to start thinking about that year after year impost that they have to pay land tax. But of course, Michael, it'll just mean perhaps in certain areas which are attractive to first home buyers, there'll be more competition, and it'll only probably end up having them pay the money they would have paid in stamp duty anyway.
Well, that's the way it's always worked before. So with a limit of $1.5 million, it's very likely it's going to help underpin the apartment market in New South Wales, Andrew.
Yes, well, here's an idea for the New South Wales government. Why don't we sort of switch to the supply side of the of the problem and just build a few more houses and a few more apartments, but that's probably a bit too hard. So we'll just throw money on the demand side. And if it means higher prices, it means higher prices. But as I said, the issue in New South Wales, the issue Australia-wide, is we don't have enough houses for the people who are demanding them.
Now, over the weekend, the auction markets were giving us an indication of what the mood is. Buyers are being a little bit more cautious, but so are sellers. They're getting a little bit more realistic. And there was a suggestion that up to 30% of properties that were listed for auction this weekend were withdrawn. I guess vendors are getting a little bit nervous, Andrew.
Well, it's winter, Michael. We expect this. It's the end of June. This is the time when buyers and sellers are distracted. We've had a lot of news about the beginning of school holidays and the issues that's had with airlines. So, not so much thoughts there of buying and selling property as usual this time of the year, and exacerbated because we're now out of that horror of lockdowns of the last few years. So there's always those distractions that add to the elements of the cycle. So they're the seasonal distractions. But of course, the cycle is waning. We have higher interest rates following a very strong period. But I actually think the results on the weekend were to some degree encouraging, Michael.
Yes, Sydney picked up, didn't it?
Sydney picked up, and even what we've seen is a falling away of auction numbers, particularly compared to the same time last year. But we've got to remember we were in a revival a year ago in our housing markets following lockdowns. So we're coming from quite a high base. So comparing the auction numbers this year to last year, we have to take that into account. But certainly numbers have been down, but Sydney numbers weren't too bad. In fact, they were higher to end June's weekend auction market. They were higher than the previous weekend, and the clearance rate was also higher. So we're certainly not in those stratospheric 80% plus results. But I still think that even though it's more finely balanced, it's still a market where sellers are finding buyers. And even though prices growth may be flatter, I think that we've still got a market which may be just still in favour of sellers in Sydney and Melbourne as well. Melbourne's actually, even though its numbers were well down, Michael, and of course we should have expected that with the beginning of school holidays. As we said, it's been a real stampede out of the state, take advantage of those school holidays and get out of the cold. But those numbers were down, but still quite a solid clearance rate there, above 60%. So the Melbourne market has held its own over the last month with that significant interest rate increase. The market that sort of headed south has been the Canberra market, and that's now well down on its previous highs and the underperformer. And Adelaide continues to be the top performer, but clearance rates are certainly lower than where they were earlier in the year. Again, the seasonal impact and, of course, the impact of the cycle now starting to wane. But we move into July now, Michael, and that is the trough of the auction season, the annual auction market. We would expect to see continued downward pressure on clearance rates, certainly auction numbers. But so far, really, I'm a little surprised that they've held as they have, given the negativity, particularly coming out of the media in terms of the usual hysterical predictions of house price crashes. But I'll just point you back to one thing, Michael. If we look back to the era which was similar to this, which was towards the end of 2018, where we did have the fear factor infecting housing markets. A lot of absolutely nonsensical predictions were getting traction in the media as to the prospect of house prices. We actually had clearance rates ending the year in the 40s. So we're well above that now in it's similar-ish circumstances. So I think we can take that as a reasonable positive going forward.
Well, if you put it into perspective, 2/3 of properties are still selling at auction. Yeah. I know from our teams on the ground in Melbourne and Sydney, they missed out at auctions because there are still buyers for good properties who are prepared to pay. And clearly, vendors are now becoming a bit more realistic.
Yes.
I've heard that a lot of properties, while they're passing in at auction, are selling at negotiation straight after auction because vendors now recognise they can't get the price they could get maybe 5-6 months ago.
Yes, and look, we'll be releasing the June quarter house price data, Michael, this week, of course. First with the news, as usual. And of course, we will be showing some certain decline in the quarterly growth of prices, particularly in the high-flying capitals of Melbourne and Sydney. But it is a much more balanced market now between buyers and sellers.
Great. Look forward to seeing what the statistics show for the end of the financial year. Catch up with you in a couple of days to discuss that, Andrew.
Thank you, Michael.